Then I want to dive in a little bit deeper to some of the nuances of this strategy that you outlined in your book. Can you give us a high-level overview of what the strategy looks like and how it addresses these 4 major investment risks?
Essentially, what we're saying is that the 3% rule, which is if you have $1 million by day one of retirement, the most you could ever take out of that portfolio is $30,000 per year adjusted for inflation. So you have to save, if you want $100,000 per year, you have to save $3.33 million by the time you reach day one of retirement. That's not realistic for a lot of Americans. There's a less expensive way of doing it. If you can offload longevity risk to a company that can manage it much better than you can personally, then you can actually do so much less expensively. So for example, I know interest rates ebb and flow, so you'd have to look at what an annuity company could give you these days. But let's say you gave an annuity company $1 million of your liquid portfolio. So you're handing a chunk of your liquid retirement savings over to an insurance company, and they in turn will give you a guaranteed stream of income designed to last as long as you do. And let's say that the distribution rate that they would allow you to take off of that annuity is 6%. So what you did was you said, okay, I'm going to hand $1 million over to an annuity company, and it's going to allow me to take 6% or $60,000 per year every year till I die. Contrast that with the 3% rule that says that you really should not take more than 3% of your retirement portfolio out in any given year, adjusted for inflation. Well, by utilizing an annuity, and again, this depends on interest rates, you could potentially accomplish the very same thing with half the amount of money. Okay. So it's just much more economical. It's much more feasible for the everyday American to have a guaranteed stream of income or to have a high likelihood of not running out of money before they die if they do so by way of an annuity. So that's the overall premise, is that you can have guaranteed lifetime income that mitigates a lot of these risks, particularly sequence of return risk. We also talk about how it mitigates withdrawal rate risk. If you have your income guaranteed in retirement by an insurance company, and you know that that is going to come to you rain or shine, you're not relying on your stock market portfolio to be able to meet your lifestyle needs. So you're much less likely to take out 10% or 7% or 5% in such a way that it would bankrupt your portfolio far in advance of life expectancy. And so we also talk about inflation risk and long-term care risk. I really think that long-term care risk is one of the most pernicious risks facing Americans these days. I'll share with you a quick dialogue, Casey, that I like to use with my clients. I'll be sitting across from Mr. and Mrs. Jones, and I'll say, Mr. Jones, you know I love you, right? And he'll say, yeah, Dave, I know you love me. I'll say, I do love you, but you're better off dying than needing long-term care. And he'll say, they look a little bit shocked, and they'll say, why that? And I'll say, why is that? And I'll say, well, at least if you died, Mrs. Jones here would be beneficiary in all of your accounts. She would get your 401k and your IRA, so on and so forth. And while we would all miss you terribly, life for Mrs. Jones is going to carry along relatively unchanged. However, if you didn't die, if you almost died, then all of the money that Mrs. Jones is planning on receiving over the course of her life now gets earmarked for the long-term care facility. What does she get to keep? She gets to keep one house, one car, a minimum monthly maintenance needs allowance of about $2,500 a month, and about $130,000 of cash. So what was shaping up to be a perfectly rosy retirement for Mrs. Jones turns into bare bones subsistence type living. And of course, the converse is true if Mrs. Jones ended up needing long-term care. So the problem is, how do you mitigate this? People don't love paying for traditional long-term care insurance. Why? Because it's expensive. You could live, it could be hard to qualify for. You may live to be 120, but if you have a bad back or a bad knee or a bad hip, you may not even get accepted. And what happens if you pay for 30 years and die peaceful in your sleep, never having needed the long-term care insurance? Guess what? They don't send you all your money back at the end. It goes to pay for someone else's benefits. So that can be a source of heartburn for a lot of different people. So in the book, we talk about ways to mitigate long-term care risk without all of the heartburn that traditionally goes into mitigating long-term care.
Hey, sorry for the interruption. It's Casey, and I know you're listening to the Retirement Purpose podcast because you want to maximize your financial efficiency and plan for a retirement that's filled with meaning and purpose. So I've got something for you. If you want to take this a step further, I want you to head on over to retirewithpurpose.com and sign up for weekend reading for retirees. This is a collection of handpicked articles with commentary from myself sent every Friday straight to your inbox. Sign up and I'll send you an email right away containing one of my favorite recent podcast interviews with insights into my biggest takeaways. Second, I want to share one of my favorite articles featured in my weekend reading for retirees, along with commentary and an ebook copy of my best-selling book, Job Optional. And finally, I want to invite you to my upcoming webinar, where I take a deep dive into important concepts that will help educate you on making informed decisions for your best retirement. I want to provide you with the best of the best resources of what we have here at Howard Bailey to offer, and we've made it easy to get started right now. Again, all you need to do is go to retirewithpurpose.com, sign up for weekend reading for retirees, and we will help get you on track to living a secure retirement that's filled with meaning and purpose today.
So it sounds like we're carving out a portion of our portfolio to create a guaranteed income stream, cover our expenses in retirement as long as we live. We're doing so with some type of annuity. And then we have other after-tax dollars that we've set aside to cover inflation, long-term growth. And we're also going to be converting the IRA to a Roth IRA to mitigate tax risks in the future. So we've got the annuity being converted to a tax-free income strategy. We have after-tax assets to guard us against inflation in the future. And then we have additional assets that we're setting aside that will be leveraged for long-term care risk.
That's right. You did a much better job of summarizing what's in my book than I just did. So well done.
Well, I'm glad we outlined it from a high level, but I think some of the nuances are what's going to catch people off. And the first piece I want to go into is probably just hitting on guarantees and annuities, the A word in the financial world. I mean, guarantee is said, and I think antennas go up to say, well, nothing's really guaranteed but death and taxes. You're pretty big on the tax piece. What is really guaranteed? What does guaranteed mean when you talk about guaranteed lifetime income?
Yeah, I mean, guarantees are based upon the claims paying ability of the insurance company, but it basically says, look, if you give an insurance company a liquid chunk of your retirement savings, they will in return give you a stream of income that's guaranteed to last as long as you do. So what they're essentially doing is they're taking your assets and they're pooling them with the assets of thousands of other people. And they know that some people are going to be living much longer. They have that Methuselah gene, right? They're going to be living much longer. Some people are going to walk off the curb and get hit by the Mack truck, so they're going to live a much shorter life. But when you average it all out, it's what Tom McKnight calls mortality credits. The people who live much longer than they anticipated are going to have their guaranteed stream of income funded by the person that stepped off the curb and got hit by the Mack truck. So all in all, everybody gets a guarantee that their income is going to last as long as they do. And of course, like I said, based on the claims paying ability of the insurance company.
So you talk about different types of annuities in there. Most of the research that's out there today seems to focus on SPIAs or immediate annuities. What type of annuity do you think best fits in this guaranteed income portion of the portfolio?
Well, I think that mathematically speaking, the SPIA is going to give you the most bang for your buck. Okay. If you look at all the insurance companies and it's a pure mathematical decision, say I can give you $1 million, which company is going to guarantee me the highest income month over month every year until I die? You can even spreadsheet it. It's pretty straightforward, and some companies give you more income than others. What I noticed, however, is that there are basically three things that really give people heartburn over the single premium immediate annuity. And there's no getting around the fact that when you give a big chunk of your liquid savings to a insurance company in exchange for that guaranteed lifetime stream of income, you are giving up liquidity on that money. And that is a reality that prevents a lot of people from ever entering into the contract, entering into the proposition. And that's one thing. The other thing is most SPIAs don't adjust for inflation. So people say, hey, look, you're giving me $5,000 a month. That's perfectly adequate to cover all of my expenses in the here and now. But because of the inexorable effects of inflation over time, even 12 years from now, that's going to have half the spending power at a reasonable rate of inflation. So is not having any inflation protection, giving the rate at which the federal government is printing greenbacks, is that really smart? And then the final one is, let's say you do enter into the transaction. 2 years into it, you step off the curb and you get smashed by that Mack truck. What happens to all that money? Does it go to your kids? No, it goes to the risk pool and it goes to pay for someone else's income. And so the combination of these three things, and study after study after study have said that those three factors are the reason why single premium immediate annuities are gaining very little currency among retirees. They have such positive benefits, but they're gaining very little traction among retirees. And so I talk about an alternative that seems to mitigate all of those concerns for most Americans. And that's what I call a fixed index annuity, which basically allows you to tie the growth of your income to basically a stock market index. As that stock market index grows over time, your income grows commensurately. And so that can be a great way to protect yourself against inflation over time. And it also has a death benefit feature, which basically says that should you step off the truck and get hit by the Mack truck, your kids will get whatever money you didn't spend plus the growth over the course of your life up to that point where you died, and they're the beneficiaries and all that account. So the fixed index annuity, and also gives you liquidity on your money during the deferral period, by the way. And so that really tends to mitigate the three concerns that most Americans have over instruments that provide guaranteed lifetime income. And I think that you and I have seen, and we've seen this across the industry, that fixed index annuities are far more popular than single premium immediate annuities because of their flexibility and their ability to speak to those three basic concerns that people tend to have with single premium immediate annuities.
Well, and I'll say this kind of as a side note. I had a conversation with Dr. Wade Pfau a while back, and I was saying, why do we see that fixed index annuities often actually have better guaranteed income rates than we see with SPIAs? And he said it's a certainty factor. The insurance company knows everyone's going to take the income from the immediate annuity. However, with the guaranteed income fixed indexed annuity, everyone has that. However, only a fraction of those are actually going to utilize the guaranteed income benefit, because you have advisors that are selling guaranteed income benefits as if they are going to grow your real money over the rest of your life. And the income benefit is never actually turned on for a lifetime. I think that's one of the really interesting things about guaranteed income benefits with fixed indexed annuities. And I also see for you and your strategy, when it comes to tax planning and playing defense against rising taxes, a SPIA doesn't work all that well. Because if you drop $500,000 into a SPIA, you can't convert it systematically over the next, as you said, maybe 8 years, 5 years. You can't just do 10% of that SPIA every year. You have to do it all at once on the front end before the income starts coming to you. But the fixed index annuity allows you to do that fractionally.
Right. That's exactly right. So the SPIA, you drop an IRA into a SPIA, and once that's set in motion, there's no turning back the hands of time. I mean, what's been done is done. It's irrevocable. And so what you've essentially done is you've cemented your exposure to tax rate risk over time. If tax rates double over the next 10 years, there's absolutely nothing you can do about it. So let's say that taxes go for you from an effective 20% tax rate to an effective 40% tax rate. That dramatic reduction in income. And one of the things that I like to tell people, and this is sort of the culminating point in the book, is that your income in retirement can be guaranteed. But if you do it within the tax deferred bucket, the after-tax amount is not guaranteed. And that's the rub, because you are sort of beholden to the IRS. As tax rates go up, the amount of after-tax income that you get to keep goes down. And where do you think most Americans go to plug that hole in their guaranteed lifetime income? They go to their stock market portfolio and they spend down what's remaining in their stock market portfolio. What happens if by taking money out of that tax deferred bucket, that guaranteed, that SPIA income, that increases your provisional income to the point where you now have a $5,000 tax on your Social Security. How are people going to pay that tax on their Social Security? Well, they're going to take more money out of their stock market portfolio to plug the hole in their Social Security. So there's two holes that can be created in your guaranteed lifetime income by situating your annuity within the tax deferred bucket. And the combination of those two holes And the act of compensating for them can, force you to spend down your stock market portfolio 10 to 12 years faster than you ever thought possible. And I think that a lot of advisors out there don't recognize the unintended consequences of positioning those SPIAs within the tax deferred bucket. And so part of the point of my book was just to educate not only advisors, but members of the general public that you should be very, very thoughtful before you decide to drop a huge amount of money into a SPIA or into an FIA, for that matter, that doesn't have the ability to allow you to do that piecemeal internal Roth conversion.
So we're mitigating some of this with the fixed indexed annuity. Where does the LIRP fit in? You've had books written all about LIRPs in the past. What's a life insurance retirement plan? How does it fit in? I have my guaranteed income. I have some after-tax funds set aside to fund the Roth conversions and to be there for long-term growth. What's the life insurance retirement plan exactly? Where does that come into play?
That's a good question. I think it really serves two purposes in retirement. Okay, so the first one is your money is growing safely and productively within the LIRP. And so after 10 years, and I usually say you definitely need to wait 10 years because these programs need a chance to really gain a head of steam. But after 10 years, there's going to come a time in your retirement where you need to pay for discretionary expenses, whether it's those aspirational expenses or those shock expenses. And your guaranteed lifetime income between your Social Security and your annuity income may not be enough to meet the cost of those discretionary expenses. And so what I say is in the years where the stock market is down after the 10th year of retirement, and you're reluctant to take money out of the stock market because you don't want, to take money out while it's down. That's just sort of a sequence of return risk in and of itself. I think this is the perfect time to start taking money out of your LIRP. So the LIRP, you're guaranteed to not lose money. So your money's growing safely and productively. So you're not going to experience any negative consequences as a result of sequence of return risk. So it's the perfect vehicle to fund discretionary needs when you need to plug the hole in your roof, or you want to take the kids or the grandkids to Disney World, but you don't want to draw upon your stock market portfolio because it's down. Take the money out of your LIRP. The money's growing safely and productively. The other part, as I said earlier, I talked about the risk of long-term care. What most LIRP companies allow you to do these days is to receive your death benefit in advance of your death for the purpose of paying for long-term care. So for example, you have a death benefit of $400,000. You wake up one day, you can no longer feed yourself, bathe yourself, transfer yourself, what have you. Find one doctor to write one letter to that effect. They will start sending you 2% of that death benefit, or $8,000 a month, every month for 4 years for the purpose of paying for long-term care. And guess what? If you die peacefully in your sleep 30 years from now, having needed long-term care, guess what? Someone's still getting a death benefit, probably your kids. So there isn't that sensation of having paid for something that you hope you never have to use. And so in my mind, the LIRP is very, very useful in the sense that you can draw tax-free income out to pay for those discretionary needs when your stock market portfolio is down. And the death benefit doubles as long-term care. And should you die peaceful in your sleep, never having needed long-term care, then your kids get a death benefit. I've noticed that 80% of my clients who enter into LIRPs do so because of that long-term care benefit.
Mm-hmm. I think there's going to be this question from some regarding funding of this vehicle and funding the Roth conversion taxes as well. And some advisors would have you convert your IRA into a life insurance retirement plan, into a LIRP. Some would have you convert the IRA into a Roth IRA. Do you support both of those? And if so, what's the correct balance? Do we use the after-tax funds to fund the LIRP? Do we use the IRA funds to fund the LIRP? What's the right balance?
Well, in the Powers Year, I talk about how the ideal amount of money to have in your taxable bucket, which is usually your emergency fund, is about 6 months worth of basic living expenses. We come across people all the time who have far in excess of 6 months worth of basic living expenses. So if you find yourself in that position, that is the perfect account from which to fund your LIRP. There are occasions where people don't have any money in their taxable bucket at all, and you're sort of forced to peel off a portion of the Roth conversion, take money that would have otherwise gone into your Roth conversion and put that into your LIRP to be able to get that long-term care benefit. What I am opposed to are these sort of IRA rescue programs where they say, let's take your IRA, let's shift it into a life insurance policy over 3 years. Let's take a loan from the life insurance policy to be able to pay the taxes on the conversion. or the distribution from the IRA into the life insurance retirement plan. That's something that I'm sort of inherently opposed to. But I think it's okay if you have a surplus of money in your IRA, and that's the only way that you can fund the LIRP to get that long-term care benefit that is so crucial to a balanced retirement plan. I think that there's nothing wrong with that.
Well, individuals think about life insurance as something that is there to provide a death benefit. What is the type of life insurance that you are supporting when it comes to using it both for tax-free income and a long-term care death benefit?
Well, so I feel like it's absolutely crucial when it comes to life insurance that the money be growing safely and productively. There's a product called a variable universal life policy, which your cash value ebbs and flows with the stock market. And part of the issue is that if you get into your 60s and 70s and you experience a massive drop in your cash value due to a major downturn in the stock market, then the way these things work is as your cash value grows, the amount of life insurance you're required to pay for goes down. But if your cash value goes down, then all of a sudden you can be in a position where the amount of life insurance you're required to pay for rises dramatically. And if that happens, when the mortality costs internal to the policy are most expensive, which could be in your late 60s, early 70s, so on and so forth, then all of a sudden it could send your policy into a death spiral from which it never recovers. And then you run out of money, you run out of death benefit, you no longer have long-term care. So I like having the policies that have a guarantee that you'll never lose money. Money's growing safely and productively. So there's two approaches at that point. You can either have a whole life policy or what's known as an index universal life policy. I tend to favor the index universal life policy because the money grows a little bit more productively than the whole life policy, and it tends to have better loan provisions, which are the means by which you take those dollars out tax-free. There's a lot of companies that offer guaranteed 0% loans, which I think is a really big deal because you don't want the interest to snowball and once again force you to run out of money before you run out of life. So index universal life, it tends to be what we propose, but there's a lot of people that tend to favor whole life that hand out my book, The Power of Zero, all the time. And it's sort of just different strokes for different folks.
Life insurance has evolved tremendously over the last year, 10 years, 20 years, just like our tax environment. And we had some recent legislation that changed the world of life insurance, or it will start impacting life insurance here in the coming months, as we'd expect. HR 133 had some regulations plugged into it. Can you just speak to what types of things are changing in the life insurance world? Is it favorable? Is it unfavorable? How does a consumer leverage these things to their advantage if they want to go down the LIRP path?
When a lot of these life insurance programs got created, there was a section of the IRS tax code, section 7702, which governs the amount of money that you can put into these life insurance policies. The IRS, believe it or not, does believe that there can be too much of a good thing. And so they have strict limits on how much money you can put into a life insurance policy. And those limits were premised on what interest rates were at the time. And so what they basically said was, given, say, a 4% interest rate environment, this is how much money you can expect to be able to put into a life insurance policy. And we're going to be limiting it because we believe that 4% will grow and compound your money over time. So there's a reduced amount of money you can put in. Well, we all know what has happened to interest rates in the interim. And so what they basically did, and this was as a result of a successful lobby from organizations within the life insurance industry, they basically said, look, these policies aren't going to be able to have the same types of outcomes if in this low interest rate environment, we're only allowed to put in the amount of money that you previously allowed us to put in under the 4% interest rate environment. So what they did was they said, okay, we're going to dramatically reduce the interest rate variable in this equation. And what that effectively resulted in was consumers can now put almost twice as much money into these programs than they were previously for the same amount of death benefit. So and that's just good news for everybody, because what it means is that you're going to be able to stuff even more money into these policies and grow your money even more productively over time, because there's going to be less expense that's draining on that policy. I did a podcast on this. We call it the LIRP Christmas Miracle, because it happened over Christmas. And it was just a overall wonderful net benefit for clients that are going to be entering into these contracts.
Now, these types of strategies, do they work for anyone regardless of their age or their health? If we are already in retirement, could we implement a strategy like this? Or do we need to be a number of years out from the time we're actually going to be stepping into retirement? I guess that's question number one. And then that kind of leads into number two. What if we aren't in the best health?
Yeah. So I'm not as much dissuaded by someone who's 60 or 62 who wants to enter into an LIRP, because we aren't generally recommending that they take money out for 10 or 12 years, right? So that's going to build a head of steam. As time wears on, the amount of insurance that the IRS requires them to purchase gets smaller and smaller and smaller. So they become more and more efficient as time wears on. So generally, you get to the point where you're 65 and older. I tend not to love this as much for an accumulation type of objective. The other thing that you have to consider is that think of the LIRP as a bucket of money with a spigot attached to the side of it. Okay, so you put your money in. As your money grows, your bucket begins to fill. The IRS says, hey, we're going to give you the benefit of an unlimited bucket of tax-free dollars. We're going to require that there be a spigot attached to the side of your bucket through which flows on a monthly basis some expenses. What are those expenses going to go towards? They're going to go to pay for that death benefit that's part and parcel of the overall product. Part of the problem is, well, I don't know if it's a problem, it's just a reality. Insurance companies are in the business of predicting how long you're going to live. They're like odds makers in Vegas. They're very, very good. I mean, if you go to your doctor says, hey, I think you're going to live a nice, long, healthy life. What does that mean? It's meaningless. If an insurance company comes back and says, we think you're going to live to be age 82, they don't tell you this. But if they said that, that means that they're willing to bet money. They're putting their money on the line that's how long that they think that you're going to live. And so what these underwriters at insurance companies do is they assign you a rating. They send you through a pretty intense underwriting process. They look at your medical records, they take blood, they take urine, and they basically come back and say, we're going to give you a rating. And I like to sort of quantify it in a numerical way, anywhere from 1 to 30. 1 means you walk on water, you're going to live forever. 30 means you're on death's doorstep. They got to sort of hold out a mirror to see if you fog it. And then you can get everywhere in between. Okay. I think as long as you're a lot closer to a 1 than you are a 30, then the LIRP mathematically can make sense. But you do have to go through that underwriting process to see if it's a fit. You don't have to do that for a SPIA or for an FIA because there's no health component. But because life insurance does have a death benefit component, insurance companies want to make sure you're not going to die in the first 10 years, because if you die in the first 10 years, it's a great deal for you, but a horrible deal for them. They want to make sure you're going to live a certain amount of time so that they can, so it's a worthwhile deal for them.
It's almost a balance that you're creating in the portfolio, maybe somewhat of a time-weighted diversification approach. You have the annuity, you win if you live a long time. You've got the life insurance, you win if you don't live as long.
That's exactly right. In fact, there used to be strategies, you may remember this, where they had medically underwritten SPIAs where they basically said, let's go see if we can medically underwrite this so that we can base that SPIA on how long you're actually going to live. And then let's find an insurance company that's going to give you as much death benefit as possible for that amount of SPIA that, income that you're getting. And there were a way to play insurance companies against each other. They no longer do that, but there was a way to sort of take advantage of that arbitrage that you're talking about.
I know we're coming to a close, and I just have one final technical question for you. And it had to do with something I found in the Q&A segment of your book. You had a question that said, should I elect guaranteed lifetime income in one of these vehicles as single or joint life? Should we have a single guaranteed lifetime income or a joint lifetime guaranteed income? You recommended single, and I think that'll catch a lot of individuals off, especially married couples of the same age or about the same health. Why would they choose a single lifetime payout? That seems like we're kind of taking a step back from the mitigation of risk.
Well, one of the caveats that I said in there is that if you can figure out which of the two spouses is going to live the longest, then that is the proper approach. So, for example, if you have the annuity that lasts as long as both spouses, then that's one thing. What I basically say, look, if you can go through the underwriting process and you can have the insurance company tell you which spouse is going to live longer, and they're, like I said, they're very, very good at predicting how long people are going to live, put the annuity on the spouse that's going to live the longest. That way, you're not ever going to be in a situation where one spouse dies and that income stops and that other a spouse is sort of left twisting in the wind. And so if you can figure out how long, and plus you have the death benefit that is there to cover you as well. So that was my approach. That's my philosophy, that if you can figure out who's going to live the longest, it informs a lot of different decisions that you make vis-a-vis retirement planning.
Unfortunately, it doesn't mitigate the Mac factor, as you called it in your book, which at first I go, what's the Mac factor? Oh, yeah, Mac truck. That makes sense.
Yes.
But if you have the LIRP as part of the overall portfolio, especially if both spouses have the LIRP and you elect the single lifetime income, you have that piece to fall back on. So you're really you're maximizing your lifetime income. And then if you get it wrong, the wrong person dies first, you have the death benefit to fund the surviving spouse.
Yeah, it's exactly the same concept behind the pension maximization. Take the single life option and then buy a life insurance policy with the difference. And if the person happens to die, then the surviving spouse gets the life insurance but death benefit.